Hey there, and welcome. We're about to jump into one of the biggest, most fundamental questions in all of finance. Should you try to beat the market, or should you just be the market? Okay, let's get right into this classic debate, active versus passive investing.
So here's our game plan. We'll start by setting the stage for this big debate. Then we'll dive into what it means to be an active investor, and then what it means to be a passive one. After that, and this is the fun part, we're going to look at the hard data. We'll even check out a potential middle ground, and then wrap it all up to help you figure out what might make the most sense for you.
You see, at its core, this isn't just about picking different funds or stocks. It's really a clash of two totally different philosophies about how the financial markets actually work.
And it all really just boils down to this one question. Do you believe that you or a fund manager you hire has a special skill or an edge that can get you better returns? Or is it just smarter to own a piece of everything and ride the wave of the entire market? Let's start with that first idea.
So let's think about the active investor as a kind of market detective. They're putting on the trench coat, grabbing the magnifying glass. They believe the market is full of inefficiencies and hidden clues. And their job is to go out there and find them, to uncover undervalued stocks, spot trends before anyone else, and ultimately outperform the crowd. So what does that actually mean? Well, the key thing to remember is that active investing is a very hands-on approach. It's all built on the idea that a really skilled manager, someone doing deep research and making strategic trades, can consistently find those golden opportunities that everyone else has somehow missed. And the people who are big on this approach will tell you it has some real advantages. I mean, active managers aren't just stuck tracking an index. They have the freedom to sell off stocks when things look risky, they can use more complex strategies to guard against a downturn, and they can even do things like sell investments at a loss to help lower your tax bill. Okay, so on the complete other side of this debate, we have the market philosopher. This type of investor isn't trying to outsmart anyone. Instead, they accept the market's collective wisdom. The goal isn't to pick the winners, but to simply own a tiny slice of the entire market and grow right along with it. Now, this whole philosophy is built on something called the efficient market hypothetics. And put really simply, it's the idea that all known information, all the news, all the reports, everything is already baked into a stock's price. So by the time you hear about some hot tip, yeah, that information is already old news. The market has already reacted. So trying to find a bargain is pretty much a fool's errand. The goal isn't to beat the market, it's to capture the market's return over the long haul. And, the benefits here are pretty powerful. For starters, since you don't have a big team of analysts and traders picking stocks, the fees are incredibly low. You also know exactly what you own at all times. And that buy and hold style means way fewer trades, which is usually much better for your tax bill. Honestly, it's a super simple kind of set it and forget it approach. All right, so we've got two really compelling philosophies here, right? The detective versus the philosopher. But what happens when the rubber meets the road? Let's get into the performance showdown and see what the actual numbers have to say. And first, we have to talk about cost, because this is a huge deal. On one side, you've got the higher fees for active funds, which pay for all that research and management. But on the other, you've got the tiny fees for passive funds. And look, we're not talking about a small difference here. This creates a really high hurdle that active funds have to clear just to break even with their passive counterparts. Which brings us to this, the big picture. This comes from Hong Seng Investment, and it's looking at how active funds did against their passive benchmarks over 10 years. It's simple. If a box is orange, passive investing won that year. If it's green, active won. And, well, just look at all that orange, especially in big developed markets like the US and Europe. And if you need one number to really hammer this home for the US market, here it is. According to data from S&P, over the last decade, a jaw-dropping 87.42% of all large-cap US funds failed to beat the S&P 500 index. Let that sink in. That means fewer than 13 out of every 100 actually succeeded. But hold on, it's not a total slam dunk for passive everywhere. The data does tell a different story in emerging markets. So why is that? Well, the theory is that these markets are just less efficient. Information might be harder to get, there's less analyst coverage, which creates more opportunities for those skilled market detectives to actually find those hidden gems. And this really shows you the difference in the journey an investor takes. That smooth orange line, that's the passive fund. It's a pretty consistent ride. That yellow line, the active fund, well, it has higher highs for sure, but also much lower lows. It just goes to show you the kind of volatility that can come along for the ride with an active strategy.
So, is that it then? Are we just stuck choosing between these two polar opposites? Well, what if there was a third way, a strategy that kind of tries to blend the best of both worlds?
And that is the exact question that led to this new wave of investing strategies that people are calling smart beta. Think of smart beta as the compromise. So just like a passive fund, it follows a strict set of rules. But, and this is the key difference, instead of just buying more of the biggest companies like a normal index fund does, it builds a custom index based on specific characteristics or factors that have historically been linked with better returns.
And these are some of the heavy hitters. For instance, a value factor is built on the idea that investors sometimes overreact and create bargains. Momentum works on the idea that what's going up tends to keep going up, at least for a little while. So a smart beta fund might tilt its portfolio towards these cheaper value stocks or ride the wave of these momentum stocks, all in a systematic, rules-based attempt to get an edge on the market.
Okay, so we've met the detective, the philosopher, and now this new hybrid strategist. So where do you fit in? How do you actually choose? Let's bring this all home. Let's just boil this all down side by side. You've got active. Its goal is to beat the market. It believes the market is inefficient, but the cost is high. Then you have passive. Its goal is just to be the market. It believes the market is efficient and the cost is very low. And right in the middle, smart beta, trying to outperform the market by using factors to get an edge for a moderate cost. And at the end of the day, it really just comes down to this idea from Hang Seng Investment. There isn't a single best answer that works for everybody. The right strategy for you is the one that really lines up with what you believe about the market, how much risk you're comfortable with, and what you're trying to accomplish in the first place. So I'll leave you with this final question. What kind of investor are you? Do you see yourself as that detective hunting for clues to beat the market? Or are you more of a philosopher, happy to just grow with the market's collective wisdom? Or maybe you're a strategist, looking to use a rules-based system to find that edge. Thinking about that will really help guide your path. Thanks so much for tuning in.